All right, fellow investors, value investors, and high yield dividend warriors alike have to have been side eyeing British American tobacco lately. This is maybe the one bright spot in the whole portfolio as of recently, with the market just being so volatile and so many other names getting beaten to a bloody pulp. Now, this stock pays out a pretty hefty dividend. They are a boring, wide moat consumer staple. They sell tobacco and basically nicotine. I do call these nicotine companies. They sell their nicotine products globally, so they don't have asymmetric risk in any one market where perhaps smoking rates are declining. And they tend to be somewhat defensive in these market downturns. And I think this is probably where I'm going to be happy keeping a good amount of money parked, at least in the short to medium term, while the turmoil kind of goes and subsides. And it could also potentially be a quality compounder with cheese, if you know what I'm saying. So the revenue here is not going to give you anything all that exciting. It's going to be relatively stable and boring. And also, this isn't quarterly. Actually, it's semi-annually. They are a British company, and a lot of companies that aren't in the US don't do the whole quarterly thing. Just FYI, a lot of them either pay their dividends annually or semi-annually, and also focus on the big picture either annually or semi-annually with their financials, and they're not obsessed with reporting every quarter. That's a kind of a cultural difference, I think. But anyways, they have, and these are in Great British pounds, I believe, somewhere in the 12 to say 14 billion British pounds worth of revenue each half year, basically, period. This comes with about darn near like 80% gross margins. I was seeing that their gross profit is something like 10 billion on the 12 billion in revenue. So they have disgustingly high gross margins. And their annual free cash flow is in the neighborhood of somewhere between maybe 9 and 10 billion thousand, that'd be funny, pounds, Great British pounds, every single year. So that's probably around a 40% free cash flow margin, which is, nothing to shake a stick at for sure. And it seems to be relatively steady. It is slightly up trailing 12 months versus where it was 5 years ago, but these could be kind of normal fluctuations. I'm sure they have things to contend with, like the actual price of like growing the tobacco. There's probably some X factors in there that affect things. Currency, I know, is another thing because they sell globally. And so when they're selling their products in one country and then converting that money they take in into their native currency for the purposes of like the corporate level earnings, it can, some stuff can kind of get lost in there, I'm sure, but it's pretty stable nonetheless on the free cash flow. And the best parts are yet to come. They pay out over an 8% yield on cost. Today, my yield on cost is a little better than this because a lot of my shares were acquired when the stock was cheaper. Now, there have been like small buybacks at a couple points over the last couple years, but not a lot. And that's one of the things we would like to see more of, I think, is the buybacks, as their valuation is not demanding at all. Okay, so they currently trade at a price to free cash flow of only about 5. All right. So 5 times their free cash flow. That means basically if the share price stayed unchanged and 100% of their cash flow went towards buying back shares, they would have bought back the whole company within 5 years. That's incredible. Their peers, the US-based Altria Group and the international non-US based Philip Morris International, trade at about a 9 or 10x and then about like a 17x or something like that, respectively. So in terms of multiples of free cash flow, they are severely discounted compared to the peers in the tobacco/nicotine space, which leads me to think that they would benefit a lot from buybacks. And one thing I forgot to mention when we were just taking a quick look at their dividend is it's only eating up something in the neighborhood of like 60% of their free cash flow. Their net income is wonky right now because there was like some kind of big write-off or impairment they had taken sometime. It was, I think, pretty close to a year ago at this point. That makes their net income look like it's not non-existent. But the cash flow is very much real. And I just think they're this much cheaper. They're not paying out 80% of it in dividends like Altria is. They have some room to do some buybacks here at these levels. I know for a while they've been working on deleveraging, but if interest rates come down, they may not be as concerned about deleveraging, and then buybacks might look a lot more attractive to them. Now, I would like to contrast the idea of being defensive in something like British American Tobacco compared to the approach of, let's call them some other quote-unquote high-yield dividend warriors out there, okay? So, they think that the price going down on this isn't a big deal because their 97% yield will make up for it. Okay, so this 97% yield is a trailing 12-month yield, okay? So that means if the share price right now is about $12, over the last year, it paid out about $12, give or take a little bit because it's 97 and not 100. But where was the share price a year ago? Well, somewhere between $28 and $32. So call it around $30-ish, okay? So during the course of the last year, when they paid out around $12 in distributions, the share price fell by call it about $18. That's called NAV erosion. Now, people that invest in these funds will tell you the NAV erosion is a myth, et cetera, et cetera. It's not a myth, all right? So basically, over time, it's about performing to expectation. I mean, it's actually slightly worse. I would have expected a year ago with the 97% payout, if this was performing at expectation, to have been, $24 going down to about $12. But it's actually worse, I think, probably because of right now, this extreme period of volatility will cause that erosion to speed up because they tank a lot of that downside. And then when the share price and the underlying, in this case being Tesla, if and when it starts to recover, because it's volatile, it'll recover really fast. And because the fund strategy writes calls on the synthetic position, they don't capture all that upside, it caps it. So this is quite bad. Now, if you're on margin and counting on the income from this to pay the margin loan and then make you quote unquote free money, that's also now not how it works, because in addition to this erosion, you have the fund charging you about 1% to implement the strategy. And you also have Schwab or whoever charging you, I would say, in the neighborhood of 11 or 12% on the margin. There's cheaper options out there, but that's pretty typical for a lot of brokerages. Robinhood Gold, you can get it a bit cheaper. I think it's in the neighborhood of 7.5% or something. M1 Finance is kind of in that range too. It could be a little bit more or less in there, but either way, on the low end, you're paying 7 to 8% to your brokerage on margin, or as much as 11 or 12% in a traditional brokerage. Not great if you're also experiencing this erosion. Your payouts will not, generally speaking, make up for the erosion in the fund and the management fee of the fund and the margin interest. Like, you're living in fantasy land, unfortunately. But what do I know?
Wow, fiscal philosophy, you're not very smart at all. The reason we know how to use margin because we know how to use margin. Because you don't know how to use margin, well, don't put it on us. Don't even ask us question.
Now, there is, it looks like a buy consensus from analysts, but let's set that aside. They'll have random buy and sell ratings on all kinds of things that I don't agree with, but they do think mid-ish single-digit growth on the per share earnings over the next couple years at least. Probably very achievable. It's not really that aggressive, and I could even see it maybe being a little higher if BTI got really aggressive about buying back shares at cheap prices, and there's some organic growth on top of it. They definitely are in some more emerging markets, and if they have good growth in some of their smokeless offerings, etc., yeah, it passes a basic sniff test on the growth here. Here's why I like something like BTI a lot more than something like a Yieldmax fund like TSLY. Okay, we can figure out roughly what it takes for the stock to be worth today's price, and at least have some modicum of feeling of being relatively safe or insulated from a permanent loss of capital, if that makes sense. You have the trailing 12 months of free cash flow plugged into this model with a 10% discount rate, fully deducting them for their tangible book value, which, by the way, assumes that their goodwill, etc., have no value, which is very aggressive, by the way, to the downside, in my opinion. And assuming 2 to 3% growth in the bottom line over the coming years. Oh, look at that. Still worth 35 or 36 bucks. And that's really kind of reflecting some kind of not very good numbers. And even still, because of the fact they're trading at like 5 times free cash flow right now, they don't have to do amazingly well to justify their own place in the portfolio right now. And if they were to maybe do a little bit better than this in terms of organic growth, and so especially in some of their smokeless categories that are probably more the future, and step the gas on the buybacks, and with interest rates coming down, people wanting a different source of yield that's consistent and feels safe, but isn't like 2 or 3% or whatever it is that they end up being able to get from treasuries after a couple rate cuts. This starts to look attractive, and maybe people running these models, if they're bearish on the rest of the market, bonds are not paying that well because rates have been cut, so that doesn't seem good. They might be willing to put a discount rate that's lower in here, and lower discount rate means a higher share price, and they might say, hey, I'm happy to get 8% or 7%, in which case, yeah, people will pay more for something like this during those times. You saw a time when something like Realty Income was, what was it, like 70 something dollars at one point. So you certainly do see that happen when interest rates get low. Yeah, but with Yieldmax, unfortunately, it seems like every dollar they pay you, you lose more than that dollar in terms of the NAV erosion and the fee that you pay the fund and the volatility, and not gaining back as much value during recoveries as what you lost when the stock went down. So there's a difference in approach. I know that 8.5% might be a peasant dividend to some people, but I'd rather take that and know that it's based on like actual real cash flows in a real business than some wonky options strategy that I'm too dumb to even understand. Be sure to leave a comment letting me know what you think about BTI and about Yieldmax Funds, and where would you rather put your money right now? Take it easy, everyone. Also, check out these messages. If you are still watching, it means you reached the end, and I'd appreciate it very much if you subscribe to the channel to help me grow my audience. I'm trying to get to 3K. Also, follow me on Twitter at Mr. Macho Log, trying to get my first 500 on there. Like me for the algorithm, as always. Comment below with your thoughts. They always inspire an interesting conversation. And speaking of interesting conversations, my Discord, linked in the description, has some of the best conversations, especially on stocks like BTI, medical properties trusts, even those Yieldmax funds. We do discuss what's going on with those and all the drama surrounding it. Till next time, everybody.